Pensions are a careless afterthought for some, but in reality everyone should be paying into a pension as soon as they are able to. Needless to say, they're an extremely important consideration when discussing an individual's financial situation. In this video, I'll not be providing any advice, but rather going over the basics of UK pensions. I'll be discussing the different types of pensions and their contrasting features, focusing on DC schemes, DB schemes, and the new state pension. But before going into detail, it's important to remember that pension benefits are generally inaccessible until the minimum pension age. UK government rules currently state that 55 years old is the age in which most individuals can access their pension savings and their associated benefits. Let's start with DC arrangements, that's defined contribution arrangements. In a DC pension, you pay into a pension pot, doing so on a regular or ad hoc basis. The purpose of these contributions are to build up a large enough fund with which to provide a satisfactory retirement income. You can set up your own private DC pension plan with any number of the many UK pension providers, but perhaps the most common way for individuals to build up a pension fund is via their employment. As of October 2012, it's a legal requirement that employers with at least one member of staff enrol all eligible employees into a workplace pension scheme. An eligible employee is anyone who is classed as a worker, is aged between 22 and state pension age, earns at least £10,000 a year, and usually works in the UK. And as of April 2019, the rules state that the total minimum contribution is 8% of an employee's salary. However, the rules also state that at least 3% of these contributions must be made by the employer. Let's look at a quick example. So, John works at a financial advisory firm with a salary of £30,000. John's workplace pension is set up so that he makes monthly contributions of 7%, that's £175 per month. He is fortunate enough to work for a company that matches his contributions, also paying in 7%. So John's monthly workplace pension contributions sits at £350 per month. To encourage individuals to save for retirement, the UK government offers tax relief on pension contributions. Basic rate at 20% is relieved initially, and there are two ways to receive this tax relief, the first being the relief at source method. In this method, tax is deducted from your pay before your pension contribution. Your employer deducts 80% of your contribution from your net pay and sends this to the pension provider. Your pension provider then claims the 20% in tax relief from the government. Looking back at John's £175 employee contribution, under a relief at source arrangement, £140 of John's net pay would be sent to the provider. The remaining £35 would be claimed from the government as tax relief. It's important to remember that only basic rate at 20% is claimed automatically. Higher and additional rate taxpayers will have to claim further tax relief via self-assessment. The second method is the net pay arrangement. In this method, your employer deducts 100% of your pension contribution before any tax is paid, your gross pay. Tax relief in this method is gained from paying tax on your earnings after your contribution is made, essentially giving you higher take-home pay and a lower tax bill. Here is a little comparison of John's situation using both methods. As you can see, there is no tax relief claimed under a net pay arrangement, as John's contribution has already avoided income tax. Now let's look at defined benefit schemes. In contrast to a DC pension, there is no fund to build up. Pension benefits in a DB scheme are calculated by three elements: pensionable service, pension remuneration, and the scheme accrual rate. That is, how long you have been a member of the scheme, how much your salary is, and the proportion of earnings you'll get as a pension for each year in the scheme. So it's fair to say that on the face of it, DB schemes are a little more complex than their DC equivalents. So let's just run through an example of how your pension benefits will be calculated. Rachel is part of a DB scheme set up by her employer. She has pensionable service of 30 years, earns a salary of £50,000, and the scheme's accrual rate is 1/60th. If she were to retire now, her pension benefits would be calculated in the following way. Her pensionable service would be divided by the scheme's accrual rate of 60, giving 0.5. This figure would then be multiplied by her salary of £50,000. The resulting figure of £25,000 is the annual pension that Rachel is entitled to. She is guaranteed to be paid this amount on an annual basis until she dies. It's worth noting that this figure will increase in line with inflation. Defined benefit schemes are much more secure and generally more generous than the defined contribution equivalents. This is due to guaranteeing income in retirement and not relying on a finite fund. They are, however, becoming far less common. This is due to increases in life expectancy, resulting in them being far too expensive for employers to use as a standard pension. The last type of pension I'll be discussing in this video is the new state pension. The state pension is a regular payment from the government that can be claimed by qualifying individuals at state pension age, currently 66 years of age, with a planned increase to 67 sometime between 2026 and 2028. The full amount that can be claimed is £175.20 per week for the 2021 tax year, a figure that increases annually based on earnings averages, inflation and a set percentage of 2.5%. Entitlement to a state pension is based on an individual's national insurance contributions. For simplification purposes, I won't be going into any of the technicalities, but for the new state pension, you'll generally need 10 qualifying years on your national insurance record to get any state pension, and 35 qualifying years to get the full amount. But what constitutes a qualifying year? For those that are employed, you'll gain a qualifying year if you're earning over £183 per week in the 2021 tax year. For the self-employed, you'll pay Class 2 contributions when having annual profits of £6,475 or more, subsequently gaining a qualifying year. There are layers to self-employment profits and a total of 4 classes of NI contributions, but more on that in another video. You're also going to gain a qualifying year in certain unemployment scenarios by gaining NI credits, such as having an illness or a disability preventing you from work, or if you're unemployed but either claiming child benefits or actively seeking a job and subsequently receiving job seekers allowance. You're also entitled to NI credits if you're a carer and claiming carers allowance. Pensions are very complex, and I'll be making more videos on various pension topics in future, but I hope this video has provided you with a basic understanding of defined contribution pensions, DB schemes and the new state pension. If you enjoyed this video, please give it a like, and please subscribe if you want to see more financial and investment content. Don't forget to click the bell to be notified when I next post a video. Thanks again for watching. See ya.